everybody. Welcome to this next edition of the 1Million by 1Million podcast. We are again speaking about investment in startups, and today my guest is Amos Ben-Meir from Sandhill Angels. Amos, welcome to the show.
Oh, thank you, Sulmana. Thanks very much for having me on.
So I think what we should start with is having you introduce yourself a little bit to our audience, your history with startup investing and so forth, and you've been around for a long time. So what does the industry look like from your point of view, and what are the evolutions that you have traversed in this long association with the technology startup ecosystem?
Well, let me give you first a little bit of background about myself and my career. I was in the semiconductor and systems industry for a little over 25 years. I spent most of that in various engineering roles, and as I got more experience, moved into executive level positions and led large engineering teams. Most of the focus was in high performance microprocessors and the high performance memory subsystems. In 1989, I moved to Silicon Valley, and that's really when I started my startup career. I ended up.
And you moved from Israel.
Yeah, that's right. Actually, it was my third move from Israel. I'd moved as a child, lived on the East Coast. Then I moved again in 1986 for a year and a half. Went back, and then finally came back in 1989. And that's when I started my startup career. Over the years, I ended up working either as an early employee or a founder at 6 startups. 4 of those had, I'd say, pretty good exits, and 2 of them shut down. And so that going through the startup cycle myself is what got me interested in the process of building a company, financing it, and eventually led me to start investing. So I exited my last operating role at the beginning of 2014, and that's when I joined Sandhill Angels. Became pretty active there as an investor, and then joined the board of directors. And I'm on my 3rd year serving on the board. As far as when I started investing in startups, I'd say I dabbled with it a little bit around 1999 and 2000, and then got busy with operating roles, so didn't have much time for it. And then started again in 2013, and sort of over the last 5 years became really focused pretty much as a full-time angel/venture investor.
Okay.
Have invested in about 70 companies over that period in various stages. So that maybe answered the.
And do you invest only with Sandhill Angels, or do you invest outside of Sandhill Angels as well?
So I invest. Some of my deals are with Sandhill Angels. Some of them are outside, direct, and then some of them are through syndicates. I've done a few on AngelList, as well as a number with a syndicate organization called Our Crowd. They're based in Israel. So and geographically, I would say the majority of my investments are on the West Coast, mostly in Silicon Valley or in the Bay Area. Some some in Southern California, and a couple in Seattle. Then on the East Coast, New York City and Boston, and then I've done a good number as well in Israel, but that's primarily in syndicates with our crowd.
I see.
So yeah. So
let me try to ask you some questions that would help us understand how to work with you for our entrepreneurs. First and foremost, let's double click down on Sandhill Angels. Could you please explain to our audience how Sandhill Angels works? What would be the procedure for us to work with you, our entrepreneurs to work with you? And, let's say you are interested in a company. How would we go about it? What size of investments should we think about doing with the Sandhill Angels group? And let's kind of build upon that, and then we'll come to your other methods of investment.
Sure. So Sandhill Angels is an organization that has about 100 members. The organization's been around for a long time, since I think it was founded around the year 2000, but it's evolved over the years, and it looks quite different today than it did when it started. I've been with the organization since 2014, and we do on average about, I'd say 40 to 50 deals a year, and a good chunk of those are new investments. Some are follow-ons. And
what is an average check size from the, check size perhaps is not the right word, just since you're investing in a group. What is the average round size is probably the right answer, right question.
So I'd say the sweet spot, at least what I've seen over the years that I've been a member, is between 125,000 to 250. I think that's where most of the deals fall. Those are for new investments. For follow-on,
and in the $125,000 to $150,000 round,
125 to 250.
Oh, $125,000 to $250,000 round. How many investors would typically be part of a round like that? 6, 8, 10, 20?
I'd say on average 10.
10. Okay.
Yeah. And sometimes it's more, sometimes it's less. But we end up as one entry on the cap table because we invest through an LLC structure.
Okay. So it is a check size.
Yeah, so that gives you the minimum check size is $50K. We don't do less than that, and at least 3 members need to be interested in the deal, and a minimum of $50K. And then we've done larger check sizes than $250. It varies. It can be, I think we've done as high as or as close to $1 million. But like I say, it varies. Those are outliers. The sweet spot is.
And is it one LLC that does all your deals, or are you doing a special purpose vehicles for each of them?
It's a relatively complex structure. We do annual LLCs, and within an annual LLC, we have what's called a class. Mm-hmm. And so if we do 10 new deals, let's say in 2018, they'll all fall under the same LLC, but in different classes. And any like, let's say a company, let's say we do a new investment in 2018, creates a class for that company within that LLC. If a follow-on investment happens for that company in 2019 or 2020, it'll be done under the same entity in the same class. The companies that we invest in don't see the class structure; they just see the LLC. But this is something we've done and put together with the help of of a legal firm we work with, and it.
Okay, so from the company standpoint, they don't need to know about all these details. They just need to know that they're basically working with one person in the group who's going to lead the deal and bring in the syndication from the group.
Yeah, so to the company, we look like a syndicate, really. Although when they're going through our process, they may interact with more than one person, but after we make the investment, there's just one person that interacts with the company.
Got it.
So in that sense, the group operates like a syndicate, but So.
And what about your other syndicate group? Does it have the same kind of structure, the Israeli one?
Well, so the Israeli one is interesting. I'll give them a little bit of PR here. Our crowd is actually a venture firm. It was formed in around 2013 by an experienced Israeli venture capitalist by the name of John Medved. And what they did was basically raise a fund of their own, and they vet deals like a normal venture firm would. But they also, they built this platform, an accredited investor platform, where they take part of the allocation that they get in a deal and make it available to their accredited investor network. And so their accredited investor network is global, and it's probably around 20,000 people, I think, is one of the last estimates I heard. And they invest about 50% of their investments are in Israeli companies, and 50% are outside of Israel. Now, when I say Israeli companies, it doesn't have to be geographically in Israel. It can be, one Israeli founder that started a company in the U.S. And so they have a global footprint. They invest in North America, in Israel, in Europe, in India, and also in Southeast Asia.
Interesting.
Yeah, they are. I mean, you can find out more.
That's a very broad footprint from a geographic standpoint.
Yeah, I mean, as an example, they do get access to some really interesting deals. I invested in Hyperloop One through them.
All right.
So and you have a choice of whether you want to invest in very early stage companies or later stage. So they're primarily, I'd say they're a good option for investors that are looking to diversify their portfolio across stages and across sectors as well. They have quite a broad sector.
And what about your personal sweet spot when if you were to lead a deal in either of these syndicates or personally, what your background is in semiconductors, is that what is the sweet spot or comfort zone in terms of investments?
So it's interesting. I mean, I don't actually do many semiconductor deals. I think in my portfolio of startups, I have maybe 2 semiconductor investments, and they're both software, not hardware. So, just for my own curiosity, I have worked in the semiconductor industry as well, so I have some knowledge of the industry. When you say software in the semiconductor industry, what does that mean? Can you talk about what those deals are? So one of the companies is doing yield enhancement. And so they provide a suite of software tools to allow semiconductor companies to improve yield by significant amounts. So that's one. So you can call that an EDA tool. In reality, the company software is not specific to semiconductors, but that's the first vertical that they chose.
I see. Okay.
Yeah.
So this is the next generation PDF solutions of some sort?
Well, I guess you can compare it to PDF in some sense. I think they're like I said, they're broader in what they're capable of doing. But
okay.
But yeah, the focus. The focus is.
So it's not a semiconductor company at all. It's more in the tools and optimization category, not at all a semiconductor company.
Yeah, I would agree. And then the other one is it's a company that's doing generators for analog type circuits, but in the digital domain. And so they sell software and IP that allows companies to easily generate things like PLLs and DLLs and LDOs and all sorts of other circuitry that has traditionally been in the domain of analog design, but they can do it in the digital domain. So I generally stay away from semiconductor investments. You know, the heyday for semiconductors was the 90s and maybe into the early 2000s. I tend to focus more on. Well, I'm a generalist, really, is the way I would describe it. So I like seeing startups that are doing interesting technologies in various spaces. If it's a business I understand or I can understand, and if the founding team is really strong and committed and have domain expertise, then I'll be interested in that company. So I've done investments in some investments in biotech, digital healthcare, robotics, autonomous driving, cannabis, sustainability startups that are doing sustainable agriculture and food, clean energy. I've done I've looked at actually done one space-related startup, and and I tend to focus more on enterprise level startups, meaning the selling to businesses. But I do look at also some consumer, but very few.
So let me ask you a question about when you're looking at enterprise deals. What are you comfortable with in terms of validation level? Are you looking for paying customers, product ready but not yet customers? What is the stage comfort?
So I would say for myself personally, as well as generally speaking for Sandhill Angels, we don't do many deals that are at the proof of concept stage, meaning that it's an idea on a napkin and you need some money to prove it out. We do not do many deals like that. Most of our deals are with our seed stage deals, but with companies that have either bootstrapped, gone through an accelerator, and have actually developed a minimum viable product and have had some traction with customers, either in the form of pilots or in actual contracts. And so that's where it starts to get interesting for us and for me personally. And I think in general, the majority of seed investors tend to operate this way nowadays. There are
totally.
There are a minority of firms and individuals that invest in what I call more proof of concept. That gives you a sense of where we start to look at companies and where it gets interesting for us.
So let me ask you a slightly different question, and this is in the dimension of TAM. There are a very large number of VCs operating in somewhere in the spectrum of pre-seed, seed, post-seed, pre-series A, and small series A. So, anywhere between $15 million funds to $100 million funds, maybe $150 million funds. The bigger ones, the 200, 300 million onwards, they start to do larger Series A's. But if you to look at this kind of smaller funds, all the way from the micro VCs to the small VCs, we see a very large majority of them still looking for billion-dollar TAM ideas. Is that a requirement for your investments, or do you also consider stuff that are smaller TAM ideas that could be better as acquisition exits? You build them as capital efficient businesses and then sell to a corporate strategic acquirer relatively early in its cycle. Is that something of interest to you?
Yeah, good question. I would say, generally speaking, we look for larger TAMs. And I mean, if a startup, if we see a path for them to get to the tens, maybe over 100 million in revenue, then that would be an interesting opportunity. But again, we look for startups that have bigger bigger opportunities in terms of total addressable market, as well as the specific percentage of that market that they can obtain. And so if a startup comes to us and the market size is maybe a couple $100 million, and they think they could maybe get just 10% of that for $20 million, that's not that interesting. But sometimes I think sometimes we do make those types of investments, though they're rarer. I would say they're not our typical investment. And I typically as an individual, whether outside of Sandhill or within Sandhill, I don't usually participate in those types of deals.
Okay. And what is your read of Silicon Valley's obsession with unicorns? Well,
I mean, as an angel / venture investor, I mean, I have this different perspective on it. Of course, if you're a big fund, the economics are such that you have to be preoccupied with, swinging for the fences, like getting multi-billion-dollar exits, because the economics of the fund require it. So they're looking for exits that will return the whole fund, and for that they need to put a lot of money to work and to get a significant exit, because they end up owning maybe 15% of the company when an exit happens. But as an angel / venture investor, I would be happy with a smaller multiple, like anything above 10x is fine. So I'm if a company I invest in can get an exit that's a couple $100 million, and that means more than a 10x return for me, and for the other investors that were involved, I consider that a success. I mean, this is an asset, as an investor, this is an asset class that has very high risk, and the majority of investments end up being losers. So and there are ways to mitigate that, depending on how you build your portfolio and whether you do just early stage or later stage. But so I do the unicorn mania, as you call it, something that larger funds require, not so much.
You don't necessarily need to be part of that. What?
Yeah, although in the portfolio, I do have a couple of companies that are valued over $1 billion. So
can you talk about those? I was just about to ask you what are the highlights of your portfolio. So let's do that next.
Yeah. So I mean, I've had a number of exits that have been between small to reasonable, but the particular company that is now worth more than $1 billion. The two companies. One is Juul Labs, which is an electronic cigarette company, and I shouldn't say too much because they're still private and they're very, very, very strong revenues and may go public within the next couple of years. That is, I mean, some people frown on that type of investment. It's because it is in the cigarette space, but it is an electronic cigarette and healthier than the traditional tobacco leaf cigarette. So that's been a good one, both for me and for the group. And then another one which I made outside the group is a company called Glass Point Solar, which is it's a solar company that's using solar energy to generate steam for enhanced oil recovery in the oil and gas industry.
I see.
And they've got a huge facility that they've built for PDO in Oman, and they recently got a big contract here in California with, I think the company's name is ERA, and they're going to be building a huge steam generation facility at Bell Ridge Field near Bakersfield, California. So in general, traditional enhanced oil recovery has used natural gas to generate steam. What this company has done is it's replaced that with solar mirrors that reflect the sun's rays and focus them on pipes that are carrying water, and that focus of energy on the pipes causes the water to turn into steam, which feeds into directly into the steam injection in a mature oil field that needs to pump steam into the ground to extract oil. So that's been a good one. I mean, these are huge deals. The one in Oman and the one here in California, and they've got a strong pipeline of additional deals. So that's looking like it'll.
So if you look at 2017, the deal flow that you have encountered, what trends do you see?
Yeah, so well, a lot of AI and machine learning being applied sort of everywhere.
Yeah, it's everybody everywhere.
Yeah, I recently invested in an interesting company called BioCatch, which uses behavioral biometrics to authenticate users that are using financial and e-commerce applications either on their desktop or their mobile device. Yeah. And so that through AI methods and machine learning methods, they create a profile of biometric behavior, which is very interesting. A lot of AI and machine learning went into that, but that's we see a trend. A lot of companies applying that to products selling into the enterprise. I've seen quite a number of space-related startups, whether it's to deploy microsatellites in space for internet coverage or for imaging, or for various other things. A lot of sustainability startups in the food and agricultural space. Yeah, like the Memphis Meats and those types of companies. Everybody's been hearing and seeing crypto startups, whether it's crypto infrastructure or ICOs. I've stayed away from the space because I think it's not clear where things are going to fall.
Yeah, very unclear.
Lot of robotics and autonomous driving-related startups. And those are interesting. All aspects of autonomous driving, whether it's LiDAR or radar or the software that's going to be making sense of all the sensors in a car to try and understand what the car is seeing. And we're seeing interesting deals in healthcare and biotech.
Yeah, healthcare is very interesting. I think healthcare is one of the most interesting fields right now.
Absolutely, yeah. There's a lot of work going on in the gene editing space and the in genomics. And also in just accumulating data on patients and being able to use that data in various ways. So so there's a lot of interesting startups. These are the kind of trends that we're seeing. But I mean, you name the latest trend, and we're probably looking at it. Including cannabis. I have one cannabis investment as well.
Yeah, we don't do those.
You don't
we only do technology and technology-enabled services, and absolutely not onto cannabis. All right. Well, that's actually a very good overview of your activities, and I think our audience has got a pretty good flavor of what you like to invest in and what you're seeing in your ecosystem. So we will continue, as we go on. I think we'll get together in person shortly, and thank you for sharing your thoughts.
Oh, you're very welcome. It's been a pleasure.
And audience, thank you for listening. We will come back with more, as you know. Meanwhile, if you'd like to use the online roundtables to come and get some mentoring, go to the website 1Mby1M.com and go to pre-public roundtables and register to pitch or attend. That's one of the ways that you will learn by actually working on your project with me. And we will see you soon with another edition of the 1 Million by 1 Million podcast.